Actually, when we look at the drivers behind gold, the tariffs may or may not have an impact, but the key drivers remain in place. Emerging market central banks have been looking to diversify away from counterparty risk of US dollar at the margin. They need to hold reserves in US dollar assets because that's the deepest, most liquid market in the world. But the continued buying from EM central banks has put a demand in for physical gold. And then we have portfolio hedging flows from other investors, and also retail clients have been getting in the act the last couple of months as well. So we still retain our overweight on gold, and those types of diversifiers in the portfolio.
Look, I'm sure you've seen this, read it, even talked about it with people, right? Trump and his people are looking at the amount of gold that the U.S. has in their reserves, right? Fort Knox and several other places around the country, and going, hold on, what's the value of this, and is it marked to market or not? And this is as a way of, I think, theoretically, if they sell some of that, hey, that would take care of at least some of the debt. If they sell some of that, the supply comes onto the market at a time when everybody's trying to chase gold to 3,000 or even higher. What happens and how much risk is there?
It's a great question.
Yeah.
And backing up to 1 second, the US has done this 3 times before, in the 1930s and twice in the 1970s. Right? So, and the question really comes, if they revalue the reserves and give Feds updated gold certificates, and the Fed can use printed money to buy that, what does the Fed do? Does it sterilize the extra money supply, in which case it's less of an inflation pressure, or not? And then the second part is, with the money the Treasury has, do they pay down existing debt, or do they extend and do new initiatives, keeping the existing debt in place? So it very much matters from an inflationary perspective and a growth perspective what those outcomes are.
So is it still safe to hold gold then?
We remain our overweight simply because the revaluation doesn't change the supply and demand dynamics in the physical market.
Okay.
Where you're actually effectively just repricing what somebody else is already storing at $42.
Gotcha. Okay, now, Treasuries, let's talk about that, right? Because the other idea on the table, and this is a part of a white paper which came to be known as the Mar-a-Lago Accord, which I'm sure you know about, right? One of the ideas, right, on the spending side, or to rather pay down the debt, right, is to basically go, look, you bought U.S. Treasuries, you're a foreign entity of some sort, even a country, whatever. Well, I tell you what, we're going to swap them, right, for something cheaper, and then we have to pay you less interest. I mean, that is just absolutely bizarre. How much risk does that put over holding Treasuries?
I think just the mere question of it really raises the question of counterparty risk on US dollar assets. Treasuries being perceived risk-free. Now, investors are looking at it and saying, well, look, am I an ally of the US or not? If I'm not an ally, all of a sudden I've got huge counterparty risk on my Treasury positions. And that is significant for countries that have huge surpluses, like China, for example. And so the ability to do that is one thing, but just raising the question whether it comes through as a policy or not, I think it puts investors on edge.